I have a special guest today, a mortgage specialist from here in the Annapolis Valley, and he's going to give us some of his insights as to the past year and what we could look for in 2024. So next up, we have Chris Golding from Mortgage Intelligence here in the Annapolis Valley. So he's been in the business over 18 years. So I'm going to shoot it over to Chris to let him give some introduction of himself, and we'll go from there. Welcome.
Hey, thanks for having me. Yeah, I should update my website. I'm a little longer in the tooth than that now. I actually have been an independent mortgage broker in the Valley for about 22 years now. And I came into the finance world right out of university and worked about 8-9 years for other companies, and then decided I wanted to be a mortgage broker. And I was, I guess, back in the pioneer years when mortgage brokering was becoming a thing. And back then we were kind of seen as a last resort, if you will. And it's grown into a more professional occupation. And now it's a big part of the real estate world. And very well with the banks now.
So how has the market been for you let's start back at the beginning of this year and this past?
Well, everything seems slow now because we were so busy during the pandemic years. I mean, they were record-breaking real estate years for us here. And Nova Scotia's never experienced anything like that when it comes to real estate. The number of transactions and the increase in values and just a different kind of negotiation out there compared to ever before. Multiple bids, so this year it's kind of been a little bit of a breather. We kind of all have come back down to earth, and supply has really caught up to us, I think. And my world's a little bit different than a realtor's world because I'm dealing with my current client base, which allows me to help people with refinancing and switching, transferring mortgages from one lender to another, or just servicing my clients. And but I have noticed a huge reduction in the amount of purchasing that's going on out there. I just think, I have a lot of pre-approved people that just can't find a house.
Yeah, that was my next question. Are the mortgage applications down, or is it just fewer mortgages being applied for or being approved?
The number of applications right across the board is down for sure. Our numbers as an industry are down. But at the same time, the value of everything's so high. So I don't think our volume is down, but I think almost like an uneasy feeling because we're not as busy, or I'm not as busy. And I like being busy. Yeah. But at the same time, there's just, you're doing the same amount of volume, but it's kind of like sitting around waiting for stuff to happen sometimes. And but it's definitely unit wise, we're not as busy.
Now, are you finding a lot of applicants being denied?
No, if anything, I think underwriting, when it comes to lender, they're kind of trying to make things a little easier for people right now. Okay. There's been a lot of, I won't say loose underwriting, but I will say they're trying to create products because housing is a huge problem. And so I think, there's been a loosening of the rules behind the scenes that people don't really know about. But, for instance, in a rental scenario, when people are buying an income property, they changed the underwriting policy for how much rent they'll use to help qualify that mortgage. Okay. So it used to be when an insurer was involved, so you got Canada Guarantee and CMHC and SAG, underwriting these files, they would only use 50% of the rental income from a property to help qualify that deal. So the person buying that property had to be very, very financially strong. And they used, not only do they have to have a lot of money to put down, but they have to be financially strong to carry what they have, plus the rental when you're only adding 50% back. But the new policy, it's only a couple months old. They're now using 100% of the rent from the rental unit. And it makes it easier It's not easy right now, but it makes it a lot easier for like somebody buying an owner occupied property that may have an in-law suite that they can rent out, or a rental unit inside of the property. They'll use 100% of that rent, add it to the gross income, and then that makes the deal way easier to get financed, or it creates more affordability.
Yeah, definitely. So you're not necessarily seeing the mortgage rates holding people back from buying the first home. It's so the price of homes themselves.
Well, you sent me that scenario. You asked me which I felt had a larger impact on people's ability to buy. Was it the price, the rates, or inflation? And when you look at them as a standalone issue, it's definitely the price. Like I have to put my glasses on because I wrote this down, but I went and did a scenario, and 5 years ago, when my first time home buyer client was going out to look for a bungalow, like a little 3-bedroom bungalow, the 24 by 36 square box, sitting in or out of a subdivision, they could get a house for $200,000. And that would have been a nice bungalow, with all the features and really just turnkey walk in. 5 years ago, the rate was 3.59%. Let's not talk about rate yet. Let's so 200,000 5 years ago at 3.59. Your payment was $995 a month, just principal and interest. Come ahead 5 years, that same exact house, if you're lucky, maybe 320. Would you agree? You're there. I think 320 maybe. It would definitely be all of 300 if you're lucky. I don't know too many people buying a bungalow in a subdivision for 320 even. But let's use 320 as a number with 5% down. At 3.59, let's just keep the rate the same as it was 5 years ago, $1,593 for the principal and interest. So that's a $600 difference. Yeah. Now, if we look at rate, let's do an economics analysis here. 200,000 at 3.59 is the $995. Say prices didn't change at all, and they're still getting that $200,000 house today. At best rate today is about 5.49 on a 5-year fixed. And that's $1,204. So if it was just rates, it would only be about $200 difference in the payment versus the price. But we can't look at things like that. We have to look at it in real terms. And the problem that we're seeing is not only did the prices amplify, but the rates went way up. Yeah. So you take that $320,000 house at today's rates of 5.49, the best rate, and the price of that is $1,927. Wow. So it's doubled. That's a $932. And then you add the inflation stuff in, and that's impossible to measure over 5 years. Like for me, all I know is it's changed a lot. People going out and their grocery bills are huge compared to what they used to be. The price of insurance, noticeably, that's gone through the roof. Heating a house, there's all kinds of things. So I can tell a person, you qualify for a $320,000 mortgage and your payment's going to be $1,927, but I want you to take that payment home and then add everything else that you got to pay for as a tenant today, because it's going to be the same. Yeah. And make sure that you can budget that. Yeah. And that's where I think the real obstacle is people. I think consumer confidence right now is really at a low, and you asked me, what can we do, or what's going to bring these people back to the buying or to the housing market. A, houses. That would be the first thing, and then B, I think the only inflation. The problem with inflation is I find once things get to a certain level, they stay there. Like there's not a whole lot of industry that changes their prices way down. Like you don't see a whole lot of dropping as time goes on. It's always a little bit of increase here and there. Mm-hmm. So I don't see housing going down in price in our area because there's just too much demand. Yeah. Yeah. But I think rates are the only thing right now that are going to expand people's affordability. Yeah. As you can see, it might have been price that hurt going this way, but I don't think price is coming back.
No.
Not for the person buying the $320,000 house. Like that new entry level price is for good.
Yeah.
And that's my opinion. And so as the rate goes down, the payment, because it is 320, it's not like that was 210 was the difference in a $200,000. So that 210 is a higher number when it's 320 as rates come back down to earth, and they will. So I think rates will help. And then just the media, as we start coming out of this recessionary period that we're entering, and the government starts announcing rate drops versus rate increases, that consumer confidence will be the other thing that gets people off the fence.
I had some questions about government programs. Like I know they have the incentive program about building in-law suites, and I've heard there's changes where you can co-sign on a mortgage or be with not necessarily a family member. Are there a lot of people buying into those programs, or are they aware of these other programs that might get them into home ownership?
Yeah, we promote them. There's a few. There's a few, and I've used them all. And there's tons of strategies out there. The first one would be our own province's down payment assistance program. That's fantastic for people that are buying their first home. And when that first was introduced about 4 or 5 years ago, it was very stringent on being a first-time home buyer. You could never have had a house. If you answered yes to that, you were done. So they've aligned it more with CRA's policy. So people that are coming through separations, they qualify as a first-time home buyer again, even though they might have owned a house in the past. Or if you sold a house 4 years ago, you become a first-time home buyer again in that 5th year. And, so I think in our territory, it's $375,000 is the ceiling. Then there's an income criteria for the household. And I can't remember exactly what it is, but I think it's like 145 for the house.
Wow.
And you have to have good credit. I think it's the same rule as getting a gifted down payment or a borrowed down payment mortgage. You need at least a 650 credit score.
Okay.
But of all the incentives that are out there, to me, that is the best one. We have used the federal government one where they've kind of become part of, like, they're a partner in the equity of your home. And it can help people that are right at their cap. So if that person buying that $320,000 house really only qualifies for a $280,000 or $90,000 house, I don't know the exact math, but the government will put 5% down with your 5% down. So it becomes a 90% mortgage versus a 95% mortgage.
Okay. Oh.
And then in the future, when you sell, if that 5% appreciates, then the government owns a portion of that for their down payment assistance. Okay. So read that one a little more carefully. We do use it when we need to. But the one from the province, I just find a lot more user-friendly for people, and they understand. And that provincial one, it's interest-free. So you get to pay it back over 10 years.
Okay. So now, what about the stress test? I've heard they've eliminated the stress test in certain scenarios coming up.
Nothing to do with buying a house. The stress test.
Renewals.
Yeah. So, and it's only if it's insured. So it's a very small percentage of, I don't know what, I think it's 25 or 27% of all mortgages are insured. And then the rest are like uninsured or conventional, where people have put more than 20% down or they're already refinanced. So what it does is it creates a fair playing ground. I think if lenders are not giving you the best rates, you have the opportunity to go to another lender for the best rate, and you're not getting re-underwritten at the new benchmark rate, which is 2% over the contract for everybody else. Yeah. But there's a lot of people lobbying, a lot of agencies lobbying for every mortgage to kind of have that stress test removed.
Yeah.
Feel
especially at these rates.
Yeah, we're kind of peaked out, right? Like if they're done climbing, and if anything, they're going to go down sometime in the next year, hopefully.
Yeah.
So we're almost overkilling that stress test.
Yeah, exactly. Yeah. Now I have two more questions. First of all, what are your current rates as of today?
I did write those down. The 5-year fixed rate, which I'm not really thinking people should be taking right now, because I do think rates are going to drop. And I can't in good conscience tell people that a 5-year fixed is a great deal, but it is the lowest rate out there. It's
Okay.
5.49. And that's in the insured version of the rates. So that's if you're putting 5% down or 10% down, anything under 20% down. And a 3-year, there's some lenders that are now coming and offering good specials on those. I think I saw like 5.89 or 5.84 on a 3-year,
Okay.
which makes way more sense because I do believe rates are going to drop over these next few years. And we're never going to see those unless something else catastrophic happens out there. But if everything stays somewhat the way it is, rates should drop down a couple percent. And
Okay.
but it won't be that pandemic level, like that 2.49. I don't think we're going to see that anymore. Again, unless something crazy goes on out in the economy and the world.
Yeah.
And then variable rates kind of may be the way to go right now. You can get prime minus 0.9, 0.95, depending on the day,
Okay.
which would start you off around 6.25 or 6.3 on a 5-year variable.
Wow. Okay. Wow. Okay. Well, I am going to post your contact information in my comments below. But final question: what's your big prediction for 2024?
I think the winter months leading into the spring are going to be kind of like where the economy bottoms out, and I think we'll see some more negative numbers. But I think when you look at where we've come from to where we are, that's a good thing for what's going to happen afterwards.
Yeah.
And I think once rates start dropping, again, consumer confidence will increase, and I think we're going to have some more robust times. I think, as long as all these building incentives for big builders happen and there's houses available, people are going to become buyers. People should never try to time the rate environment. It's like buying stock and you're trying to time that price, right? Like it never works to your advantage. Like we illustrated earlier in this conversation, the price of housing has a much higher impact on you than a rate. So if you're good to go and you want to be a homeowner,
Yeah.
now is the time, because
That's
it's only going to become more expensive.
Yeah. Okay. Well, thank you very much. It's been a pleasure, and definitely be keeping tabs. And sorry, I just cut out there for a second, but yeah. So thank you again. Take care.
All right. Thank you. See you.
Bye. Thanks again to Chris Golding. And again, his information is down in my comments section below.